Well, I think really for two reasons. One, that's where the growth in the world economy is going to be. You know that emerging markets from practically nothing now has half or more of the world's GDP. Emerging markets are growing much faster than developed markets. The IMF believes that emerging markets will continue to grow faster. And one of the reasons that they're going to grow faster is that their populations are growing and their populations are young, as opposed to the Western world where we are aging rapidly, where the number of retired people and non-workers relative to workers is shrinking. In a place like Japan, very soon there will be more non-workers than workers. In a place like Japan, they're likely to lose about a third of their population over the next 15 years. So they've got the population growth. The productivity is going to be there because all of the advances that have been made in the Western world can be incorporated into emerging market companies. So the growth is going to be there. The IMF projects the growth will be there. And this is where you're going to get the greatest growth in the world. Now, the second reason you should be invested in emerging markets is that the valuations today are extraordinarily attractive. One of the valuation metrics that I think is the best metric to predict long-run stock market rates of return is the so-called CAPE, or the cyclically adjusted price earnings multiple. This was popularized by the Nobel laureate economist Bob Shiller. It's sometimes called the Shiller PE. And it has a 40% correlation to long-run stock market returns. Well, that CAPE in emerging markets is in the vicinity of 12 or 13, a very low reading. That CAPE in the United States is in the vicinity of 30 to 35, an extraordinarily high reading. So that relative to the valuations in the developed markets, the emerging markets are the cheapest markets in the world. So basically, the growth is going to be there and the valuations are extremely attractive.